Hello, welcome to Express Notes P7. This is Chapter 8, Subsequent Events. As always, the big picture. This is another one of those key areas where assumed knowledge from F8 exists. So this must be a key part of your preparation for P7. Examiners' reports at this level have often expressed concern about students' lack of understanding of the basics, i.e. they've forgotten F8. So I don't know how long ago you did F8. It might be worth you just whipping out your F8 express notes and just having a quick refresher on this particular area. Now, the attraction of the syllabus area to the examiners perhaps always been the fact that it is an area which readily lends itself to a very practical, scenario-based question. So in other words, you have a business. After the year end, something happens which you have to account for. Is it material? That's the first question. Is it an adjusting event or not an adjusting event? Is it before you sign the audit report or after the audit report? So it's a very nice scenario-based question to have. Plenty of examples, both probably the examiner's experienced or has heard about, and puts it into the question. And then perhaps ties it in with audit reporting. So, key terminology, subsequent events. They relate to events occurring or facts emerging. So, events or facts emerging after the accounting period end, but before formal approval of the financial statements by a company's management. Adjusting events are those which relate to an item or condition existing at the statement of financial position, i.e. the balance sheet, where the subsequent event assists in forming an opinion as to the amount properly attributable to such item or condition, where at the balance sheet statement of financial position date there was some doubt, so it provides extra evidence. So there's an example the notes give here of making a provision at the year end because of the subsequent insolvent liquidation of a customer. So a customer that owes you money, presumably a material amount, and then goes insolvent. So gives you an adjusting event. Non-adjusting events are those which do not alter the year-end position, but which would have had a material impact on the financial statements if they had occurred prior to the year-end. Such non-adjusting events should be communicated by way of notes to the financial statement. And this is where your audit reporting comes in. Has that note been put in? And if it has been put in, has it been adequately put in? Okay, and there's a good example in the notes here, a destruction by fire of one of the company's warehouses. As auditors, we should give careful consideration as to those events which at first sight may appear to be non-adjusting, but actually could impact something called going concern. So your example here, it might be material, £1 million warehouse plus losses plus whatever. It could be £1 billion and could cause, an impact on going concern. If you think of the Gulf of Mexico and BP and that oil rig, now I don't know when that happened in relation to its year end of BP, but imagine if it happened just after the year end, how that could have impacted British Petroleum, BP. Now clearly it's a huge company, but you can imagine an event of that magnitude could impact going concern, and therefore it should be treated as an adjusting event. Could be, should be, and that's what you need to, as an auditor, get appropriate audit evidence to establish the facts. Now, in subsequent events, we talk about something called proactive period and not proactive. The proactive period is up to the date of signing the audit report. You must be proactive as an auditor and seek out audit evidence relating to subsequent events. You need to be aware, read the papers, talk to management, be aware of the media, what's going on with your client. You need to be proactive. You can't be on holiday. You can't and ignore the phone and everything that is said around the country. So you've got to be proactive and listen. Now, typical audit procedures are described here. So during the period where best practice requires the auditor to be proactive, what you need to do, but not necessarily restricted to, discuss with management. That'll always be there. Examine minutes of any board minutes and committee meetings, which you always have to assume an exam exists. They might not in reality, but forget what you've learnt in practice. Pretend that they do exist. You will always be able to review management forecasts, budgets and management accounts. Again, in reality they might not exist, but for the exam, pretend they do. Clearly, subsequent auditing testing, sales and cut-offs will help you establish what should have happened at the balance sheet. And finally, obtaining a management representation that they've told you everything they should have done. Now, the other style is a reactive period, which is after signing the audit report, the auditor need only be reactive. So they're not, as we had up here, proactive. So now you are allowed to put the phone on hold, not pick up the newspaper, not review the internet and the media. You don't have to go and find it. Now, having said that, if you find a subsequent event that would have impacted the financial statements, you need to consider your appropriate action. The action will probably depend on the nature, timing of the event, its materiality and size, clearly. What you will then do is you will discuss with management their proposed reaction, not yours, theirs. You might revise, withdraw your early report, depending on the nature and the magnitude, materiality of the event. You might want to address the company AGM to discuss this issue. You also might need to take further advice, be it from a third party, be it from a lawyer, be it from whoever. So those are the two different sort of approaches, reactive and proactive periods. Okay, that's the end of that chapter. See you in the next one.